for June 2019 on how you adjust the additional information. Okay, there are five additional information. Okay, let's look at the first one. An annual repair of plant and machinery costing 100,000 had been wrongly debited to plant and machinery account on 4 January 2017. So if you look at the question, this is a published account for the year ended 31st December 18, meaning that the opening would be 1st January 18. So in the first additional information, it happened in 4 January 2017. Okay, so 4 January, that means this is a last financial year, okay, in the previous year. So this is considered as previous year error. So the repair expenses of 100, alright, has been wrongly debited into plant and machinery. So the effect is the repair expenses is overstated, and the plant and machinery is also okay. This one, the repair expenses di sini silap is understated sebab you did not recognize it as an expense, but you recognize it as an asset, which is wrong. So repair expenses is understated, so the effect is the profit last year is overstated, and plant and machinery is also overstated. Okay, and then when you recognize that expenses as, when you capitalize it as a plant and machinery, so you provide depreciation 20,000. Okay, it's mentioned in the question. Depreciation has been provided 20,000. So what happened is the depreciation has been overstated and accumulated depreciation is also overstated. So when your depreciation expense is overstated, your profit is understated. So how do you correct that in the current year? So when the asset is overstated, you should credit your asset. You credit plant and machinery. And when your profit last year, profit overstated, we need to reduce the profit, so we should debit, but we debit the retained profit. We don't debit SOPL, yeah, because this is a previous year profit, so any previous year error relating to the SOPL should be affecting the retained profit figure. Okay, for depreciation, last year profit is understated, so we need to increase it back, so we need to credit, so we will credit retained profit. Accumulated depreciation is overstated, so to reduce it, you need to debit accumulated depreciation. So that's the figure for each of the transaction. Okay, number 2, on 1st January 18, land and building were revalued at 26 million and 62 respectively, and the revaluation was not recorded in the books. On that date, the building had an estimated remaining useful life of 20 years. So I have summarized it here. So we do one by one. Revaluation of land. So the cost of the land is 22 million actually. Okay, fair value is 26 million. Okay, you need to be very careful. The trial balance given, they leave out the 000 at the back. So when you read the additional information, make sure you leave out the 000 also at the back. Okay, so that it is consistent. So I have leave out the 000 at the back. So cost is 22,000, fair value of the land is 26,000. So since fair value is more than the CV, so there is a surplus of 4,000. So the journal entry would be increase your asset, debit land, and credit ARR by 4,000. Okay, next is the revaluation of building. So the fair value building is 62,000 here. Right, cost I take from the trial balance. Cost of the building is 69,000. Accumulated depreciation also from the trial balance 6,900. So cost minus accumulated depreciation, you get a carrying value of 62,100. So since the carrying value is more than the fair value, so we get deficit of 100. Alright, so the entry for the deficit, you reduce your asset, you credit building 100, and deficit you need to debit SOPL. So you also need to check in case in your trial balance there was an ARR for the building, but I don't see any ARR in the trial balance. So in that case, we will debit SOPL. This is what you have learned before. If the asset has ARR, and in the next revaluation, you will get deficit, you need to use that ARR to cover for the deficit. But for this question, there was no ARR, therefore we will debit SOPL. Okay, and then remember, every time you revalue your asset, there are two things that you need to do. First, you recognize the surplus or deficit, and the second one is you eliminate the accumulated depreciation, right? So you see here, land, we recognize the surplus, but we don't eliminate accumulated depreciation because there was none for land. But building, there is accumulated depreciation of 6,900, so we need to eliminate that. So which is you reduce your accumulated depreciation and you reduce your building by 6,900. Okay, alright. And then the question move on saying that the company provide depreciation on PPE, building straight line method. Okay, so we look at building here. So after you revalue, of course, you will compute the depreciation based on the revalued amount. So the revalued amount of the building is 62,000. So divided by the remaining useful life given in the question, 20 years. So we calculate that 62 minus 20 years, so you get 3,100. So this is the journal entry for the depreciation. Plant and machinery is 20%, okay, times with, okay, remember just now we have an adjustment for the plant and machinery where you need to deduct the wrongly debited of the repairs. So you have credit here, credit plant and machinery 100. So that's why when you calculate depreciation for this year, you need to deduct this 100, okay, this one. So 43,500 you take from the trial balance, 43,500 minus the 100 here, so you get depreciation for the plant and machinery 8,680. So this is the journal entry. And motor vehicle is 10% of on the straight line method. Straight line method, that means the percentage you will time with the cost. So motor vehicle, the cost of the motor vehicle from the trial balance is 27,500. So depreciation is 2,750. Okay. Yes. Okay. So these are the entry for depreciation. If let's say you find that this is too simple, yeah, you don't have to pass the journal entry because it's quite straightforward. I just need to show you in case some of you are quite blur of what is the journal entry, because remember for published account, if you pass double entry, it will assure you that your published account will be balanced. Okay, if you miss one of the entry, then nanti publish you tak balance. So that's why I take the trouble to show. I just show you the journal entry. If you find this is not necessary for you, then you don't have to write it down. Okay, just remember to provide that depreciation before you publish. Okay, number 3. On 8 October 2018, this is during the year the company brought legal action against one of the suppliers. This topic you have learned under provision, contingent liability and contingent asset. So in this case, the company sue outsiders. So this is not liability, this is either asset or contingent asset, or you ignore. So in this case, it says that the lawyer were of the opinion that most probably the company would win the case. So of course this is not asset because asset need to be virtually certain. So this is not asset, but this is a contingent asset because it says here most probably company would win the case. So this should be disclosed in the notes to the account. Okay, it does not. There's no journal entry for that. Okay, number 4. During the stock count carried out on 29 January. 29 January is after you close your financial statement. Alright, so this is the event after reporting date lah. So inventories amounted to 50,000 were damaged. It means that so when we talk about event after reporting date, whether it is adjusting or non-adjusting. So in this case, this is adjusting because you have reported your closing stock at the end of the year. So when you find that during this period, you find that the stock has been damaged, therefore those figure that you have reported is not correct. So you have to do the adjustment. So when the closing inventory is overstated, the effect is the COGS in this year is understated. So you need to correct that. So you have, when it is understated, you need to increase it. So debit COGS. And when your closing inventory is overstated, you need to reduce it. So you need to credit closing inventory by that amount, 50,000. Okay, number 5 given is the tax expenses 32 million. Alright, and then you check in your trial balance, tax paid given is income tax paid 32,500. So the difference is 500. Okay, because you are paying more than you are charged to. You are charged with 32,000, but you paid more than that by 500. So this 500 is current asset. We call it as tax recoverable. So for this one, you just need to remember tax expense goes into SOPL and the tax recoverable goes into SOFP. Okay, and then the question also says part of the debenture interest was still accrued at the end of the year. So look at your trial balance. You have a debenture. So your debenture is 6% times with 60,000 cost. So 1 year the interest should be 3,600. And you also look at your trial balance. You can see there is a debenture interest of 1,800, meaning that the balance 3,600 minus 1,800 has not been paid. Okay, that's why the additional information number 5 says that part of the debenture interest was still accrued. So you get 1,800 that is accrued, that will goes into under current liability. So your interest on debenture should be 3,600 per year. So that's why this one, another 1,800, we pass the journal entry debit SOPL 1,800, credit accrued interest 1,800. Okay, so that's all for the additional information. It's quite simple. Alright, so I'll continue in the next video.